With rate cuts anticipated as early as September, when we take a look at the ETF, which holds the real estate investment trust, they are up over 7% just over the last 30 days. So in today's episode, we are looking at 15 individual REITs that we believe will go up as the rates do start to come down over the next few months. We're going to take a look at each one individually. We're going to take a look at their rating summary, whether they are a buy or not from the different analysts. And for each single one, we are going to jump into the valuation model. We're going to get straight into the intrinsic value, their acceptable buy price, given our investor margin of safety, and we'll also look towards Wall Street to see what their forecast is and understand whether or not these undervalued REITs are ones we should start adding to our portfolio today. So let's start and jump into the first one, which in today's episode is Realty Income Corporation. We can already see a triple buy rating. In fact, Quant do give it a strong buy. When we do look over the last year, it is down around 8.5%. Over the last 10 years, however, it is up around 32.65%. We do note it hasn't come back up to the highs we saw just before the COVID crash, around the $80 mark, and we note in today's value it is trading in the midpoint of the 52-week range. Remember, this is a dividend company that pays every single month, a forward yield of 5.59% and a P to FFO on a forward basis of 13.04. So let's jump straight into the valuation of Realty Income. Now, typically on this channel, we do a lot more in-depth deep dive. We also run through every single one of the valuation models. As we said, today's episode, very brief. We just want to understand the valuation of each one of these 15 real estate investment trusts. Today's episode of Realty Income, we do get to a value of $64.63. Now, the current price does trade around $55, and for each one, every REIT, every company on this channel, we always start off with a margin of safety of 10%. We only execute on that if it meets our 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. So then we keep going till it's near the current trading price. And for today's episode of Realty Income, we do see around a 15% MOS level. As we can see, that would indicate a buy around $55, which isn't too far off the current trading price. In terms of Wall Street and their expectations, well, over the next 12 months, as we can see, they do believe the share price will go up to around $61, $62, and they have implied upside around 11%. So in conclusion, for Realty Income, a 15% MOS level on the judgments today, and around 11% from Wall Street and their targets. As always, as we go through the remaining of this list, do let us know your thoughts in the comments if you are buying any, or if you are looking to add it onto your watch list. The next REIT that we are looking at today is Vici Properties, very similar to Realty Income, a triple buy rating. Quant do give it a strong buy, as we can see here. Over the last 12 months, it is down, as we can see, 2.5%. If you have been a shareholder, though, over the last 5 years, you would be up 34%. Bear in mind, all of these numbers that we look at don't include dividends reinvested, so you would be up slightly higher if you were to reinvest. Similar to Realty Income, it is trading around the midpoint of the 52-week range. We do note it has a nice starting yield as well of 5.48% and a P to FFO on a forward basis of just under 12. So in terms of the valuation of Vici Properties, and as always, if you do enjoy the content, values being provided, do smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Intrinsic value just under $38, current price around $30, margin of safety then 10%. We do see an acceptable buy just under $34, at 15% around $32, and in today's episode pretty much trading bang on a 20% margin of safety. In terms of Wall Street and their expectations, well, over the next 12 months they do see more upside than Realty Income, with their price target at $35. And for full transparency, Realty Income and Vici Properties is one that we also do hold in our own portfolio. The next REIT that we are taking a look at is Stag Industrial. In fact, this is another one that we also hold. We have a double buy rating. However, we do notice that Wall Street does give it a hold. It is one that is trading in the midpoint again of the 52-week range, a yield of just over 4%, a P to FFO as well of just over 15. Over the last year, however, positive returns plus 6%. Over the last 10 years, we do note this is up 53%, although it is some way away from the all-time highs that we did see around the $45 to $50 mark at the beginning of January. So in terms of Stag Industrial and the valuation, let's get straight into it. Don't forget, you can grab a copy of this valuation model by clicking on that pinned comment below. You can get to the intrinsic value as well as the acceptable buy of companies in your own portfolio, as well as those on your watch list. Current price then $36, margin of safety at 10%. We do notice pretty much at that price now. So Stag Industrial, this is in the industrial space within REITs, giving a 10% MOS level. In terms of Wall Street, well, they also believe 10% upside. In fact, their price target isn't too far off our intrinsic value. So 10% MOS in today's episode with a 10% implied upside over the next 12 months. Moving on then, we have ESS, Essex Property Trust. We have 1 out of 3 buy ratings, a double hold rating. It is a company that is trading towards its 52-week high. It does have a yield of 3.7% and a P to FFO of just over 17. Over the last year, well, very strong performance, in fact, up 27%, and we can see over the last 10 years, up 47.5%, although again, similar to other REITs, it hasn't reached its all-time highs, as we can see here, around $354 around 2 years ago today. So in terms of Essex Property, let's take a look at the valuation. Valuation then in today's episode is the average of these 3 models, coming to $276. In terms of current price, $265, so we do put in that 10% starting point. We do note it isn't quite there yet in today's episode, and we do see it not far off a 5% margin of safety around the $262 mark. In terms of Wall Street and their expectations, well, in fact, they do believe that this is trading pretty much around this intrinsic value as well as what it will be over the next 12 months. But as we can see here, we do see around a 5% MOS level. Do let us know your thoughts in the comments below. Is Essex Property Trust one you have been adding, or maybe it is one you are looking to sell? As we can see here, it isn't also too far off its intrinsic value. Just before we do jump to the next REIT, just to let you know, we have released our latest free weekly article where we run through 20 undervalued dividend stocks that you should consider adding to your portfolio. If you want access to this or any other articles, all completely free, do click on that pinned comment and sign up. Also, just to point out, this article here, how to find undervalued stocks, we run through all the websites and resources that we do use on this channel when we do analyze these stocks. So the next REIT we're looking at is Public Storage. We can see a double buy from Wall Street and Quant with a hold from Seeking Alpha. It is trading at the mid to upper end of the 52-week range with a forward yield of 4.18% and a P to FFO just under 17. Over the last year, well, it is pretty much trading flat. Over the last 10 years, however, up 76%, and we do note all-time highs around 2 years ago at that $393 mark. So in terms of PSA and the valuation, as always, if you are finding this video useful, do let us know your thoughts below if you would like more of the same or very similar content. Intrinsic value $331. Our current price in the market is $290. 10% margin of safety $297.66. So right now when we are looking, it isn't quite there yet at a 15% margin of safety. We see between 10 to 15%. In terms of Wall Street and their expectation, well, they see around 9% upside. They have a price target of $317. But with a lot of these price targets, if the company or the REIT does very well, they will revise their price targets both upwards and downwards. And I do expect overall the market, when the rates do start to get cut towards the end of this year, that we will see a lot of these REITs go on a very strong run, in fact going higher than a lot of these forecasts that Wall Street have over the next 12 months. We then move on to ADC, Agree Realty Corporation, with a triple buy rating. It is trading now in the mid to lower end of the 52-week range with a forward yield just under 5%, a P to FFO of just over 15. Over the last 12 months, it is down around 8%. Over the last 10 years, though, up nearly 100%. And as we can see, all-time high sitting around the $80 mark nearly 2 years ago today. In terms of the valuation for Agree Realty, in today's episode, it is getting an intrinsic value of just under $66. So we can see it does currently hold around a 10% margin of safety at that $59 price, not too far off the current trading value. In terms of Wall Street, well, they have a 10% upside. So with this company, if you were looking to buy now, you would be getting roughly a 10% MOS level with around 10% implied upside based on what Wall Street expect over the next 12 months. We then move on to the next REIT, which is American Tower Corp, a double buy rating with a hold from Quant. It is trading in the mid to upper end of the 52-week range. We do see a yield on a trailing 12-month basis of 3.34%, and as we can see, P to FFO just under 19. Over the last year, well, it is up marginally, plus 2%. Over the last 10 years, up 120%. But we do still see it some way away from all-time highs around the $300 mark, which we are talking about nearly 3 years ago today. In terms of the valuation, though, for American Tower Corp, one that we have also looked at, similar to the others on this channel in quite some detail, an intrinsic value arriving at $228. Current price $194, 10% margin of safety, a buy up to $205 at 15%, pretty much at the current trading price, so a nice 15% MOS level. In terms of Wall Street, well, their upside right now is 13% with their price target. Although lower than our intrinsic value, they still see some nice upside of 13%. We then move on to Prologis, which as we can see has a double buy rating with a hold from quant. It is trading towards the lower end of the 52-week range. It has a forward yield of 3.47%, a P to FFO of just over 20, and we do notice over the last 12 months, not the greatest performer, down 10%. Over the last 10 years, however, up 170%, and we can see all-time highs sitting around the $170 mark 2 years ago. So in terms of Prologis, again, one that we have reviewed not too long ago, the intrinsic value in today's episode is getting an average of these two coming to $128. With the current price around $111, the 10% margin of safety does make it a buy up to $116. At 15%, $109.20, not too far off. So again, similar to the previous company, we do see a 15% margin of safety. In terms of Wall Street, well, they see quite some nice upside for this company, which is one of the largest REITs in the world. 20% with their estimated price target $133, higher than the intrinsic value of $128. We then move on to DLR Digital Realty Trust. Quite a mixed bag that we have here. A sell from Seeking Alpha, a buy from Wall Street, and a hold from Quant. It is trading towards the upper end of the 52-week range. A forward yield of 3.37%, a P to FFO of 21.65, and we can see up very strongly, best performing REIT that we've looked at so far today, up 55%. Over the last 10 years, up 153%, but similar again, we can see some way away from the all-time highs, $177. So with that mixed rating, let's take a look at the analysis, see what the intrinsic value, whether or not we do agree, and with which analyst, in fact, we do agree. We get an intrinsic value of $169. With the current price at $145, we do get a margin of safety at 10% up to $152, at 15% pretty much around the current trading price that we have seen for the last few REITs so far. In terms of Wall Street and their expectations, well, they do believe it is trading towards its intrinsic value. Whilst we see 15% MOS, Wall Street see an implied upside of 3% with their price target at $150. The next REIT that we do take a look at, it is Equinix. Now, this is one that has a double buy and a hold rating. It is trading right there in the midpoint of the 52-week range with a forward yield of 2.13%, a P to FFO of 32.41, and over the last 12 months, it is up 12.16%. Over the last 10 years, up very strong, one of the best performing that we have reviewed, 342%, and we can see a little bit away from its all-time highs at just over $900. So let's take a look at what this is currently trading for, what it is in the intrinsic value as well. So we get an intrinsic value today of $950 with a current price significantly lower, so hopefully some nice margin of safety. And what we can see here, pretty much around a 15% MOS level. And when we have reviewed this in detail, look at the underlying metrics, this is a high quality REIT. In terms of Wall Street and their forecast, well, they believe around 14% upside at a 915 price target in 1 year's time. 15% margin of safety, 14% upside. Let us know your thoughts below whether or not this is one that you are looking to add. We then move on to EXR, Extra Space Storage, with a double buy rating, a hold from Quant. It is trading towards its 52-week high with a trailing 12-month yield of 4.28% and a P to FFO of 18.89. Over the last year, up marginally 2%. Over the last 10 years, up 192%. But again, we do see it some way away from all-time highs, sitting around that $227 mark. In terms of the valuation for EXR, let's get to the intrinsic value. And don't forget, you can grab a copy of this model by clicking on that pinned comment below, running your own numbers as well as your own companies through. Intrinsic value 174, 10% margin of safety, a buy up to 157. At 15%, not too far off again. So for EXR, we do see it near enough a 15% margin of safety. When we do look at Wall Street and their forecast, well, $165, they do see upside of 9%. And as always, do let us know your thoughts of these REITs as we go along today. We then move on to MAA, Mid-America Apartments, one buy rating from Seeking Alpha, a double hold. We do see it essentially trading in the midpoint of the 52-week range with a yield forward-looking of 4.3% and a P to FFO of 15.33. Over the last year, well, down over 7%. Over the last 10 years, however, up 93%, but it has fallen significantly, as we can see. All-time highs December 21 at $229. In terms of the valuation for MAA, the intrinsic value in today's episode is getting to a value of $162. With the intrinsic price higher up than the current price, let's get to the margin of safety. 10% 145, 15% pretty much bang on. So for Mid-America apartment communities, a 15% margin of safety. Although we do know Wall Street only see implied upside of 5%, their price target over the next 12 months currently sitting at $144. We then move on to Triple N REIT, where we have a triple buy rating. It is trading towards the upper end of the 52-week range, a forward yield of 5.33%, a P to FFO of 12.81. Over the last year, down 2%. Over the last 10 years, up 23%. But again, similar to others like Realty Income, it hasn't recovered from the highs that we saw pre-pandemic at $58. How about the valuation? Does it give us a nice enough sense of margin of safety as well as any upside from Wall Street? Well, the intrinsic value just over $53, with our margin of safety at 10%, a buy up to $48, at 15% up to $45, and in today's episode, we pretty much see it around a 20% margin of safety. In terms of Wall Street, well, they see some nice upside of 14%, with $48 their target over the next 12 months. We then move on to SPG, Simon Property Group, with one buy rating from Wall Street and a double hold from the other two. It is trading towards the upper end of the 52-week range, a forward yield of 5.38% and a P to FFO of just under 12. Over the last year, a massive surge, up 44%. Over the last 10 years, however, it is downward trending, down in fact 10%. In fact, the only REIT we've looked at so far that over the longer term has been downward trending, something just to bear in mind. In terms of the valuation for SPG, the intrinsic value in today's episode gets to $181. Margin of safety at 10%, a buy up to $162, at 15% $153, and at 20% not quite there yet. So in today's episode, it is trading towards or more towards a 15% MOS level. In terms of Wall Street and their expectations, well, they do see a double-digit upside, although only 10%, with their price target of $164 over the next year. We then move on to the final REIT today, which is IIPR. It has a strong buy from Quant, a buy from Seeking Alpha, and a hold from Wall Street. It is trading right now at its 52-week high with a yield on a trading 12-month basis of 6.37% and a P to FFO just under 14. Over the last year, a massive surge, up 66%, and we can see over the last 5 years, it is up 29%, but again, all-time highs do sit, in fact, more than double the current trading price at $284. In terms of the valuation for IIPR, and again, this is one that we have reviewed similar to all the others in detail before, the intrinsic value is coming to $126. With the current price, we get the margin of safety at 10%. It isn't quite there yet, but just a few dollars shy, so satisfied enough to say that in today's episode, around a 10% MOS level. Remember, these are based on our estimates and judgments. In terms of Wall Street, well, their expectation is $124. They do see upside of 8%. But again, as always, let us know your thoughts in the comments below. Are you buying any of these REITs? If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And if you do like more of the similar content where we just go through the valuation, do let us know below. As always, have a great day and we'll see you all on the next one.